now we are going to focus on MapMyIndia. Well, the stock is down more than 10% in last 2 days after the executive director and CEO decided to step down from MapMyIndia, though will continue as the non-executive director. But essentially the point is that he's stepping down to float a new company which will largely focus on the B2C segment of MapMyIndia. So the B2C segment is largely spin-off from MapMyIndia, and this new company will take over this B2C segment. This new company will also utilize the Mappls, which is the retail brand of MapMyIndia. Rohan will hold around 90% stake in this new company, while MapMyIndia will continue to hold around 10%. But they had also earlier announced that MapMyIndia will infuse 35 crore of rupees. But when we spoke to the management clarified that because of yesterday's market reaction, they have decided that MapMyIndia will not infuse any more funds into this new company. But let's listen in to the slice of the conversation which I had with the management earlier.
MapMyIndia has been and is primarily a B2B and a B2B2C company. Almost 100% of our revenue comes from this segment. And this is what we had talked about in IPO time also. Now, this consumer business, there is no consumer business that is existing in MapMyIndia. So transferring a consumer business is something not properly understood. What we are talking about is Rohan has a desire to build a consumer business, and that he can answer why he has the desire. And also for that purpose, Rohan wanted to float a new company on which MapMyIndia is taking a 10% stake for 10 lakhs, as you said, and also has been planning to invest 35 crores of CCD money into that company. Now, having heard the street, particularly yesterday, Rohan Verma has decided not to take any money from MapMyIndia, the 35 crores. The stake, of course, will be there of MapMyIndia of 10%. Why he has decided not to take, you can hear a little bit from him. The fundamental reason related to this change of consumer business being done outside, it was becoming a financial drag in the company. I hope everybody knows that the investments and the money that's required in a consumer business is unlimited. Nobody can define how much money is required when. MapMyIndia wanted to stay out of that and not have a drag.
Right. Okay, Mr. Rohan, okay, so this is a new development wherein, the new company will not take in the 35 crore rupees from MapMyIndia. But can you give us this reason? And my particular question is, why can't this B2C segment, be a particular segment in MapMyIndia as it is currently and be focused on rather than, floating a new company for the same?
I think the reasons are simple. MapMyIndia as a B2B and B2B2C company enjoys a pretty strong profit margin or EBITDA margins and is also growing. The addressable market is also very large in the B2B space, and MapMyIndia is a leader in that. I think for that trajectory to continue uninhibited without any drag, not doing consumer in the company, whether as a vertical or as a subsidiary or even as an associate, is important for MapMyIndia's discipline. It's a good thing. It's a good decision for MapMyIndia as a company to do what it's choosing to do. And because I have a desire to do consumer business, it's better to do it outside.
So 90% of the stake in this new company will be held by you and the other 10% by MapMyIndia.
That's right. That's right. And I'll be putting my own funds to fund this business.
Okay. So coming back to the reason of doing all this was a margin drag. Essentially, just to give a context to our viewers, margin drag is essentially the dilution in margin which was happening largely because of the marketing expenditure by MapMyIndia, and this will now be spin-off to the new vertical that can give a support to the margin at MapMyIndia. So moving on to margins at MapMyIndia, Mr. Rakesh Verma, you mentioned about the margin drag. So largely, what kind of margin target will you see an improvement, because the drag will essentially be called off now?
Well, last quarter we talked about it that around 4 to 5% drag had happened. Now, if we had continued with the consumer thing, the drag would have been kept increasing only. As I said, the requirement of the expenses in a consumer business is unlimited, and hence, if you're asking me what would be the savings on the margin, well, the drag will go away and the normal margin will come back.
Okay, and this can be effective from next year as this new company will be spinned off?
I think the effective, while the company he's forming the company this month, the impact of that will happen from the Q4 quarter itself.
Right. Okay. And the 1,000 crore milestone, which you had called out for the 5-year plan of achieving 1,000 crore, will that be majorly now from B2B or B2B2C? So is that still achievable? Because now the B2C segment, the segment which you were essentially calling off since the last 2-3 quarters as the highest growth segment, will now be spinned off. So the 1,000 crore revenue will now have to be achieved from the remaining 2 segments. So what kind of growth run rate do you see over here? Is this still achievable?
Well, I don't think we ever talked about revenue from B2C in our 1,000 crore plan. And hence I don't know why that question is coming up. But no, we will achieve our target in FY28 with 1,000 crore revenue that we have set forth for ourselves.
So this 1,000 crore was on a broad top line level, which included revenue from all the segments, right? So essentially my question will be this: since this one segment will be called off for, there will be only 2 segments from which this 1,000 crore will now be achievable. So is that still achievable? Yes, is what you've just mentioned, right?
I said yes. I think Rohan can also add value to my statement, but we never said that 1,000 crore includes a B2C revenue.
Right. Mr. Rohan Verma, can you, if you can add any inputs on this one, or maybe correct me if I'm wrong?
No, absolutely. The addressable market for B2B itself is quite big, whether it's automotive OEMs or corporates or government, enterprise. And MapIndia has 3 pillars: maps, IoT, and drones, as well as the JV that MapIndia has done with Hyundai AutoEver to focus on the Southeast Asian market. So MapIndia, with its B2B business, which is pretty solid, is clearly kind of focused on maps, IoT, drones, and this JV for the B2B and B2B2C market. And the addressable market, as we outlined last year, is quite large, about 8,000 crores of serviceable addressable market. And the team is going after this and is well on track, as Mr. Verma said.
Right. Okay. So let's talk about this new company. What kind of revenue share will this B2C provide and translate into revenue? What kind of revenue growth? Because I don't think you've called out for the revenue share of B2C segment in MapMyIndia. So if you can put some color on that, Mr. Rohan.
There is no revenue that MapIndia gets from B2C right now. It is like in the order of 10, 20, 30, 40 lakhs in a quarter. It is not even material, I would say, to MapIndia's business, the B2C revenue. So I mean, that's why this is not. I mean, so yeah.
It's not a significant revenue for MapMyIndia, the B2C, which you're talking about.
There is no revenue that MapIndia gets from B2C. MapIndia is primarily B2B and B2B2C business. There is no B2C revenue that MapIndia gets.
So this new company will therefore focus on B2C and drive more revenue growth essentially. So this will not impact MapMyIndia's revenue at a total level. Is that what you're telling me?
None whatsoever. None whatsoever.